Fortuna reports financial results for the second quarter of 2024. Highlights are attributable net income of $40.6 million or 13 cents a share compared to $26.3 million or 9 cents a share last quarter. Liquidity was $355.6 million compared to $212.7 million last quarter. Gold equivalent ounces produced 116.57 thousand ounces versus 112.54 ounces last quarter. Everything is growing except for the silver production because the San Jose mine is in its last year. And this I wanted to note, consolidated all-in sustaining cash costs per ounce of gold equivalent sold of $16.56 an ounce compared to $14.95.
Fortuna's financial results for Q2 2024 show strong growth. The company reported a net income of $40.6 million, 13 cents per share, up from $26.33 million, 9 cents per share, last quarter. Their liquidity improved to $355.82 million, compared to $322.7 million last quarter. Gold equivalent production rose to 116,570 ounces, but silver production declined as the San Jose mine nears the end of its life. The consolidated all-in sustaining cash cost per gold equivalent ounce sold increased to $1,656, up from $1,495. The yield curve inversion often precedes recessions. When inverted, banks struggle to profit from borrowing short-term and lending long-term, reducing money supply. The Fed typically responds by cutting rates, un-inverting the curve, but this action is often too late to prevent a recession. Recently, excess funds from previous money printing in the reverse repo facility allowed for a prolonged inverted yield curve. As these funds deplete, the Fed is likely to cut rates, normalizing the yield curve. This normalization could trigger a severe recession, potentially followed by another round of monetary expansion. Rafi Farber, a financial analyst focusing on macroeconomics and precious metals, observes a minor short squeeze in gold. Recent data shows open interest in gold contracts decreasing from 570,000 or 600,000 to 500,000 or 510,000, coinciding with a price increase from $2,350 to $2,470. This squeeze is supporting gold prices, but Farber suggests open interest needs to drop further to around 450,000 to fuel a new rally. Notably, gold is outperforming other commodities, pushing the gold-to-commodities ratio near all-time highs. This trend may indicate growing recession concerns, as gold typically rises, while other commodities fall during economic downturns. Bank reserves surged by nearly $200 billion in 1 week, the third largest increase since 2021. This spike, likely caused by a major market sell-off, prompted financial media concerns and calls for Fed rate cuts. Rumors of an emergency Fed meeting circulated in response to the situation. As we present clips from the video, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell to be instantly notified every time we upload a video. Thanks for the support, and enjoy the video.
That recessions only happen when yield curves un-invert or normalize. When the yield curve is below zero, that means banks can't borrow short and lend long, which means they can't create money through the fractional reserve system, which means the money supply falls. When the money supply falls, you start to have signs of an impending recession. And once you have signs of an impending recession, what does the Fed do? It cuts rates. And when it cuts rates, it cuts the short term faster than the long term, and the yield curve starts to un-invert. So the un-inversion or the normalization is really a sign of the Fed starting to act, but they're always behind the curve and they never are able to prevent recessions because Keynesian economics never works. And now, why were we able to stay below zero, to stay inverted on the yield curve and have the money supply shrink for so long? Because so much money was printed in the last printing round, and all that money was put into the reverse repo facility. And as it exits that reverse repo facility, that sustains the money supply even when the yield curve is negative. But since the reverse repos are running out now, we cannot sustain this fake economy below the zero on the yield curve for much longer. So the Fed is going to start cutting interest rates and the yield curve is going to start to un-invert or normalize. And we're not going to have a lot of time once that starts until the next recession, which this time I believe will be very severe and will cause the final money printing. We have some encouraging developments here. We have what looks like a minor short squeeze, which is able to reset open interest lower while the gold price rises. You can see in the red rectangle here, falling open interest from looks like to be about 570,000, maybe closer to 600,000, whatever that number is exactly, down to about 500,000, 510,000. So we had the gold price went from 2350 to about 2470 or something. So this is the definition of a short squeeze: contracts closing out, short positions closing out, and the price rising. It wasn't an insane short squeeze. It wasn't a non-manageable short squeeze, but it was a short squeeze, and it keeps the price supported as open interest resets lower. I want to see this go below or at least at 450,000 before I call the next rally ready in terms of the fuel available. Doesn't mean it would start exactly when we hit 450,000, but a lower open interest means that when the next rally does happen, fuel left for it. And now gold has been taking off versus commodities. Silver is hanging on at the 200-week moving average, but gold is really taking off versus other commodities. So we're seeing that the commodity complex is suffering now, and I think this is the signal of an impending recession, which is why commodities are falling. So gold isn't falling along with the commodities, which means that the gold to commodities ratio is rising. We're back at 9. We've only hit 9 once. If you take this area that's above the 9, right, and just write that off to lockdowns and insane policies, gold to commodities is at an all-time high, excluding this little period over here. And I wanted to talk about bank reserves. I've been waiting for these things to fall below 3 trillion. It doesn't look like it's happening just yet. We had a big rise to almost $200 billion this week. This is the weekly change in bank reserves going back to 2021. And this is the third biggest week in increase in bank reserves since 2021. Right here, what was this? This was the regional bank bailout, which you would expect that would increase bank reserves because you had an enormous bailout of the banking system in March 2023, which is why we had a big influx of reserves from the Fed into the banking system over here. And over here, I don't know what that is. It's July 7th, 2021. I don't know what was happening back then, but this is the third highest since 2021 of influx of bank reserves. Why is that? Well, because we had this huge sell-off on Friday of last week and Monday of this week, and people were freaking out about it, and it was all over the financial mainstream media, and like banks started to insist that the Fed cut rates.
The recent increase in bank reserves is significant, placing it among the top 12 and 13 largest weekly fluctuations since 2008. This spike was driven by market panic following a major sell-off, leading to a substantial influx of reserves. Reverse repos are expected to decline rapidly as banks move funds from the reverse repo facility into treasury bills, which offer slightly higher interest rates. Over the past 20 months, reverse repos peaked at $2.553 trillion, and a similar decline is projected by around September 15, 2024. This decrease will accelerate as the U.S. Treasury increases its issuance of bills, drawing money out of the reverse repo facility. In July alone, $150 billion in net treasury bills were issued, up from $90 billion in the first half of the year. Financial experts warn that increased T-bill issuance to fund the U.S. deficit could lead to a repo crisis similar to 2019. The rising T-bill supply may strain the banking system. The upcoming quarterly refunding announcement could exacerbate concerns and alarm budget hawks. The U.S. Treasury plans to increase T-bill sales to cover funding gaps, drawing from the reverse repo facility. With $225 billion in bond sales planned and increased T-bill issuance expected, especially in October, reverse repo funds could be depleted soon. Once exhausted, T-bill auctions may draw from bank reserves, potentially leading to a repo crisis as warned by banking experts.
This is a big influx in bank reserves due to the sell-off. This is going all the way back to 2008. The weekly fluctuations in bank reserves, you can see that we've hit here. If you count here, it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So we're in the top 12, 13 of weekly changes in bank reserves. There was a lot of panic when reverse repos finally drain out. So I made here an isosceles triangle. You can see here that for 20 months and 15 days, the reverse repos went from 0 to the peak of 2.553 trillion. And I mirror imaged that line here. And if you take the same amount of time, 20 months and 15 days from December 30th, 2022, which is when this peak happened, would take us to September 15th, 2024. It could be a little bit past that, but it's not going to be much past that. And here's why. What causes the reverse repos to fall is mostly treasury bill auctions. Banks take money from the reverse repo facility and they put it into T-bills because they're in a little bit more interest than reverse repos. Reverse repos is 5.3. And I think the treasury bills are like 5.32 up to 5.4, something like that. So they earn a little bit more basis points in treasury bills. So the more treasury bills that are issued, the more money is drained out of reverse repos. We haven't had net issuance of treasury bills since we've had like 90 billion from January to June, but now they're starting to increase. In July, we had a net issuance of 150 billion, and that issuance should rise from July 26, 2024. So here, Wigglesworth and Duguid say, among other things, smart people at JP Morgan, Barclays, and Apollo worry that the government's reliance on T-bills to fund the deficit risked a rerun of the 2019 repo crisis. So what Fry here represents is that as bills are going to increase in issuance and net issuance, we're going to pressure the banking system to enter a new repo crisis, according to these smart people, according to Robin Wigglesworth and Duguid. Here they say blood pressure already raised. Next week's quarterly refunding announcement, in which the Treasury Department makes public their borrowing plans for the coming 3 months, could make budget hawks. Note and bond sales are long-term debt. If note and bond sales are steady, that means that bill sales have to rise. The bills are what are taken from the reverse repo money to the bill auctions. So we see here, they say this outright. The Treasury Department said in a statement Wednesday it will sell 225 billion of securities at its so-called quarterly refunding auctions next week, which span 3, 10, and 30-year maturities, notes and bonds, long-term. Dealers had widely predicted that outcome, seeing the department as able to make up any funding shortfalls over the period via more bill sales. So basically, Treasury bill issuance is going to go up. And more specifically, we have this paragraph on the trajectory of the sales of bills, which take their dollars from the reverse repo facility. The department said Wednesday it expects to modestly increase the offering size of short-dated bills being auctioned next week, then keep that cadence through August. It sees modest reductions in early to mid-September when certain taxes are due. Over October, it anticipates increasing all bill auction sizes, given the fiscal situation. So we have about $300 billion left in reverse repos. We've seen from the quarterly refunding announcement that bill sales are going to increase, especially in October. So I think that the reverse repos will zero out around October, that since there's no more dollars left in the reverse repo account, the dollars that fund treasury bill auctions are going to have to come from bank reserves directly. And it's at that point that we'll start to see bank reserves really fall hard. And once they do, we're going to have a repo crisis, which the smart people quoted by Robin Wigglesworth from JP Morgan and other mega banks say is a serious problem. Once we hit the next apocalypse or whatever exactly it will be something like that.
While Fortuna's strong Q2 2024 financial results highlight growth, broader economic concerns loom. The normalization of the yield curve and the depletion of reverse repo funds are likely to strain the banking system, potentially leading to a severe recession. The expected rise in T-bill issuance could exacerbate these issues, with experts warning of a possible repo crisis reminiscent of 2019. These factors suggest that the financial landscape is entering a period of heightened risk and uncertainty. Do you agree with Rafi Farber's predictions? What will the silver market look like in the future? Let us know in the comments below. For more content like this, don't forget to subscribe to our channel, hit the notification bell, and explore our other videos. Thanks for tuning in.